Hello, and welcome once again to Equital Conversations. My name is Gerald Ashley, and on this occasion, I'm joined by my colleague Nick Rogers, who is an equity analyst at Equital. Nick, welcome aboard.
Thanks, Cheryl.
We're going to tackle a small topic today, global energy or the global energy markets, and our usual sort of challenge is how much we can talk about that in 30 minutes or so. And in fact, more precisely, we're going to talk about what I think of as the big three in energy of oil, natural gas, and maybe the one that sometimes gets a little forgotten, coal. In this podcast, we're not really going to talk about nuclear and the renewables. I mean, obviously, they're an important factor, but they're somewhat smaller than the big three I've just mentioned that represent really quite a very high proportion of the entire market. Depends where it is, but it's often between 85 and 90% of the overall markets. So let's kick off with oil. Perfect timing, I suppose, because we've had the sort of bombing by the Americans in Iran. Well, let's start with that newsworthy thought. What do you make of all of this?
Yeah, no, it's certainly been an interesting couple of weeks with the Middle East. The Strait of Hormuz, there's been a lot that's been made about the Strait of Hormuz recently. It was always sort of my view that it was perhaps a little bit overdone.
Right.
We were unlikely to see oil prices up, close to $100 or $130, as some commentators had forecasted, had the strait been closed. The demand picture this year seems to be a little bit softer than the last couple of years. The IEA's June forecast was for a rise or a moderate rise versus the last couple of years.
Now, all that would have all gone out the window if there'd been a big disruption. And one little thing that struck me, which I'm sure you're on top of, is, of course, Iran are big exporters of oil to China. So I think your Chinese in the background would have had a lot to say about the Straits of Hormuz. And one of my favorite phrases, I think, when you read social media, I always talk about the armchair admirals. And there are a lot of sudden big naval experts appear on Twitter or X or whatever you like to call it. And as you say, there was some quite sort of hysterical, immediate sort of estimates as to where the crude oil price could go. But the overall picture then, do you think that it's pretty much in balance, or in fact, maybe a little bit of oversupply of oil even?
Yeah, so there's been a couple of, as I mentioned, the US sort of demand picture has been a little softer this year. Coming into the end of the year, the economic pressures are putting a little bit of a dampener on US demand. However, in saying that, with the slide in the dollar, it is pushing up demand in other places globally. And we are sort of seeing a more broad-based reaction, particularly in places like China, India, and Southeast Asia. We've seen China, what effectively has been called the Beijing put, where they have stepped in to buy excess supply of cheap barrels. They do have quite a significant strategic petroleum reserve.
Yeah.
Some estimates are that it is larger than the US's. Certainly when you factor in the current utilization of the SPR in the US.
So they're kind of taking a sort of geopolitical view here that they don't want any short-term disruptions that are going to get in the way of their economy, particularly at a time when I think it's fair to say the Chinese economy is slowing down a little. I wouldn't say it's stalling, but the rate of growth has certainly come off a boil, hasn't it?
Yeah, certainly. It's an interesting thought I had this morning and was discussing with George Cooper. The Chinese economy, and I think the Chinese government see GDP growth as a sort of an outcome and a target.
Yeah.
And almost work their way back from that, given the large manufacturing as a percentage of GDP. The energy intensity and energy demand coming from China, given the quite lofty GDP targets, is only sort of set to grow over the next couple of years.
So they're still very much in this sort of booster mode for their domestic economy, and I know it would be a whole different topic to talk about China all day, but there is always a feeling that the government really can't allow the economy to slow down too much. They've got to, as once a friend of mine said, they've got to keep this party going, and you know, both as an economic party and perhaps as a political one as well. You mentioned India and Southeast Asia, and I guess they're in pretty much the same boat in terms of looking for growth. So is it fair to say that Europe, it's flatlining, and you say the States looks a little soft?
So the demand in the US is definitely looking a little bit more soft, just from an economic point of view. Europe is a little bit of an unknown at this point in time. Obviously, economic growth has been fairly flat for quite an extended period, but there has been quite significant talks about official stimulus and rebuilding a sort of an industrial base.
Yeah.
Yeah.
But that would take a long time to happen. You know, you can't just do that. You know, on a spin of a coin. It would be a long-term project.
Absolutely, and particularly the European Union has had a lot of focus on natural gas in recent years. There's been coal has sort of basically declined to next to nothing as a portion of their overall energy mix. Oil's still a big component, particularly around sort of freight and shipping.
Yeah.
And when we think about China, obviously being the manufacturing hub for the rest of the world, shipping is a big component of that. The tariffs in the US bring in an additional element. If Chinese manufacturers are shipping to the US, that perhaps they're shipping via another country. And obviously that adds incremental demand to oil.
So as ever, there's never a simple answer to, is it going up or going down? I can never talk about oil without wanting to wheel out something I think I've heard nearly every year for the last 30, if not 40 years, which is our old friend of peak oil. And I think some people have been trying to say it's 2029. That seems probably was something written last year and then 5 years forward. But I see you mentioned the IEA, the International Energy Agency, they're pushing it out to 2040. So the cynic in me says it's always 10 or 15 years away. Or what's your take on that?
The IEA's track record is shaky at best. They've called it many times in the past. It's quite a while away in my view. It's difficult to put a number to it, given
Sure.
Demand is still growing, and as we talked about, particularly from the global south, petrochemicals, aviation, freight, they aren't slowing down. If anything, they're increasing as a growing middle class comes from places like Latin America, Africa, and Asia.
Yeah, we get a distorted view sitting in Western Europe or even North America as to what is going out in that part of the world. I mean, I was out in Southeast Asia earlier this year, and things are absolutely booming. I mean, the atmosphere and the sort of background is so different from certainly London and I imagine Europe as well. Whilst you're talking about booms, there is a little bit of a boom. I think you mentioned to me before we came on about offshore production. Is that right?
And just adding to what we were just talking about, that demand for oil is only going to grow as the dollar slides and oil becomes more affordable for emerging economies. Their incremental demand will increase. But as you said, offshore projects are getting a lot of buzz at the moment. Offshore has very low cost barrels relative to some of the continental US, particularly the Permian.
And that slightly surprises me because the old adage was that, that offshore or certainly deep drilling was extremely expensive. But as technology opened up a lot of fields in offshore now that just didn't work before,
some of the new major projects, for instance, in Brazil, in the pre-salt oil fields, and some of the West African oil fields, profitable at as little as $30 a barrel.
Oh wow! Now that is really low, and that $30 a barrel has all sorts of implications all over the place. We could just do a program on that price, because that will have big impacts in terms of economies and, again, geopolitics and revenue coming into OPEC states and all the rest of it. Before we leave oil, because I say we could do at least 3 or 4 hours on this, my sort of take on your view here is that obviously oil's not going away quickly. I mean, latest numbers I see, it's 32% of global energy. So people say, oh, we're going to be winding down fossil fuels quickly. I mean, I just think they're flat wrong. But if I was to put you on the spot, do you think we will have a softer oil price? I'm not saying we go to $30, but do you think we could slip a fair bit over the next year or so?
There's been a lot of talk about excess capacity, in particular in Saudi Arabia. Saudi is generally known as the swing producer, in saying that over the last 2 years, the Saudi government has taken quite significant dividends from Aramco. In particular, last year, it was about 119% of free cash flow.
Which is the state oil company. And I don't know if they've ever floated it yet. They're always having talk of trying to float some of Aramco, but I don't think that's ever transpired yet. So they're kind of relying on revenues, and if revenues do drop a lot, then I suppose they will try and cut supply.
Yeah, so they actually floated Aramco a couple of years ago on the local exchange.
Oh, they did?
Saudi hasn't been spending the necessary capex to expand some of their existing wells or even explore. And that's sort of evident by the dividends that the government has taken over the last couple of years. So, in a long-winded answer, I think the floor on on oil, is closer than or nearer to where we are now than sort of some of the lower estimates, in the low 50s.
So I can't get used to lots of cheap motoring then, by the sounds of things. Well, I think we've given oil a little bit of a run there. Let's go on to natural gas. And the phrase that leaps out at me about natural gas is it's sometimes known as the bridge fuel. Can you enlighten me a little bit on that?
Yeah, of course. So natural gas is being utilized as a bridging fuel between what is being touted as potentially a renewables and nuclear based grid. LNG is a lot cleaner than coal, for instance, and we've started to see because of the cheap natural gas prices in the US has ramped up its exports of liquefied natural gas to the rest of the world. It's worth noting that there are 2 contracts. There's the rest of the world price and the US price for natural gas. It is my view that over time that those 2 prices will converge closer to what they currently are today.
So lots of professional arbitrage opportunities for the sort of smart and agile big investment firms.
Absolutely. There's been some very large-scale LNG projects over the last couple of years, and those US producers are certainly making the most of the cheaper natural gas prices.
And I saw a report by Shell, and you would say, well, they should know what's going on, but it's still only ever an estimate or maybe a very detailed forecast. But nevertheless, they're suggesting that natural gas demand could go up by 60%, but small caveat, it's our old friend 2040, which happens to be 15 years away, and Lord knows what we'll all be doing in 2040. But a 60% increase in demand over 15 years is pretty significant, I would thought.
Absolutely. There's a lot of new gas that's just coming online in the next 5 years from places like Qatar as well, Australia, also, as we mentioned, the US. China is a big driver of demand. However, in recent years, we have seen coal to gas switching and gas to coal switching, depending on which is more economic.
Right. And so, again, that you can only do if you've got the infrastructure in place. So, unlike Britain, who've been very proudly blowing up their coal-fired power stations and trumpeting the fact, that wouldn't be an option in extremis that the UK could go back to. I suppose the obvious disruptor in all of this, what looks like a rosy picture, if you're bullish of the market, is the Ukrainian war, because that, I think I'm right in saying, has pretty much upended a lot of what's happening in the European market, and I suppose by definition, as you're saying, that's changed the balance a little bit in terms of global imports into Europe as well.
Yeah, absolutely. Russia's position in the Ukraine war obviously threw a bit of a spanner into the works with regards to natural gas supply to the continent, in saying that the US has stepped in as a primary supplier of natural gas now to the continent. Over time, it's my view that the Europeans, I mean, we're already beginning to see the sort of green sprouts of nuclear, but the real, I think, topic of discussion amongst politicians at the moment is energy security, and that plays into all forms of energy, from renewables to nuclear to oil and gas.
And it's that. Yeah, and that's that dreaded phrase, supply chains. And, one would have thought that the supply chain from North America to Europe is fairly stable. People sometimes get more worried about supplies from the Middle East, because pretty much as we've just been talking about with the events in recent weeks. And of course, Qatar is, I think, sitting on probably the world's largest gas reserve. If not, they're a very close second. There is, of course, natural gas close to home, and it's a little bit more political. I mean, we've got it in the North Sea. Britain doesn't seem to be very keen on exploiting that. There's been a political move against fracking in the UK. And so we're in the, I think, unenviable position of having natural resources, but buying them in from overseas. And that might be a political disruptor at some point, as you say, about security.
Yeah, absolutely. I mean, it's a little bit silly when you think through the logic. Having a resource like the North Sea, the UK really should be tapping into that. It would lower prices of energy across the board in the UK, and in particular for our energy intensive industries, which they need desperately.
Yeah, I mean, we're seeing a lot of closing down of chemical plants. There's talk of, fewer and fewer places are going to be producing fertilizer and all these byproducts that just spin out. It's not just heating your home. There's obviously a huge industrial element. And I think that's also affected the German economy a great deal. Some people have talked about a certain amount of deindustrialization going on in Germany because of the cost of natural gas. I think we've got a few minutes left now, and we'll talk about the one that everybody forgets. But I should just start by saying natural gas was 23% of the global market. So it's still a big player. But believe it or not, a market that's bigger than that at 26% is coal. Now, again, I'm giving a rather sort of Anglo-centric view of things here. I mean, we've closed all our coal mines down. They've been pretty much in decline since the 1950s. People think, the big shift was under Mrs. Thatcher in the 1980s. But that industry had been in terms of tonnage and number of mines and everything, had been shrinking for a very long time. But of course, that's a completely sort of blinkered view of the world, because it's fair to say that coal is booming in other parts of the world, isn't it?
Absolutely. I mean, being Australian, some of our largest companies on our public markets are coal mines. We've got something like 1,200 years worth of high calorific coal in Australia. The coal is definitely an Asia-centric story, but it's definitely a dark horse for 2025. The IEA is projecting a flat demand this year, and it was moderately up last year, 1.2%. However, China is bringing on 94 gigawatts worth of new coal-fired power stations.
Yeah, I mean, they're building in a big way still, aren't they?
Absolutely, absolutely. And given the supply constraints in places like Australia for high calorific coal, if we do see any disruptions to production, the price could really take off like it did in 21. Perhaps not as significantly, but certainly we could see some upside to current prices.
So it could be a surprise story at some stage. Just to finish off on coal, and you have to be of a certain vintage to remember this, but going back to the apartheid times in South Africa, where South Africa found it very difficult to import oil and natural gas and certainly any refined fuels, they set up a big operation. I don't know if you remember it, called Sasol. And Sasol was a company that, in very simple terms, took the oil and the refined products out of the coal, because they're sitting on a lot of coal. And widening that to the general world, there's still a big market, isn't there, in what we may call coal to fuel. I mean, other than just burning it, I mean, turning it into chemicals, effectively.
Absolutely. So when we think about coal to chemicals, thinking things like products like methanol and fertilizers, this sector's a bit of a wild card. China has a sort of strategic coal reserve that it utilizes for obviously its industrial purposes, and is necessary for its manufacturing as well. However, it's also a massive consumer of fertilizers and producer of fertilizers. It's actually swung from a net exporter of fertilizer to basically, well, in some recent years, it's been an importer. And that's predominantly to satisfy domestic demand.
And that just shows how all these three markets sort of interlink, because obviously Ukraine, prior to the war, was a very big fertilizer producer because of all the natural gas they were sitting on. And so there's been disruptions there. I think if I wind up a quick run around the global energy market, which has been maybe an ambitious thing to try and do in the time constraints, certainly we can see where the drivers are. They seem very much in Asia, India, Southeast Asia. Western Europe and North America seems to be in a different spot. But then that's true of a lot of the global economy outside of energy. And of course, they're all very linked. I think we're going to come back to you in a year's time, and we do an annual review, or maybe a bit sooner, Nick. And I'm rather hoping the oil price is going to be lower, but you haven't given me very much comfort on that. We're going to finish off with our usual little thing, which is book recommendations. And as ever, I'll go first. And I've come up with a book here called Kings of Shanghai. And it's written by an author called Jonathan Kaufman. And it's a really good sort of financial history of two of the major sort of trading families that sometimes been a little bit forgotten now. The Jewish banking house of Sassoon, who started, I think, in Iraq, and they're close rivals from the same part of the world, the Kadoris. Now, the Kadoris are probably better known in modern day world because they're still a very big, significant players in Hong Kong. I think they own some of the power stations there. But it's a really interesting read of how these big trading families became very important in the sort of growth of modern China and all that flows from it. So it's an easy read. It's not a big, boring sort of academic thing. It's in many ways, it's quite racy. So there we go. Kings of Shanghai. And it says two rival dynasties and the creation of modern China. So what are you going to hit us with?
So mine's The Wealth for Sale by Jack Farchi and Javier Blas. Both those gentlemen are Bloomberg analysts, and they discuss what is essentially the origins of many of the commodity trading houses that will still exist to this day. One well-known one that many of our listeners might know is Glencore.
Yeah, very big company.
Originating from Mark Rich and Co. during the 80s and 90s, but a really great sort of book on commodity trading and how sort of commodities have sort of dominated trade over the last century, really.
They seem to have some good sources because there's quite a lot of how shall we put it, wheeler dealery that goes on in some of these markets. And I have read the book as well, and I would join with you in saying it's very good.
Yeah, it's a good read, and the insights, as you said, I think there's a number of sources that have remained anonymous, and perhaps for good reason.
Well, on that note, I think we've done enough to get the big picture on what's going on in global energy. So, Nick, thank you very much.
Thanks, Charles.
And we'll hear from you again soon. And no doubt we shall get Mr. Cooper back at some point as well. Okay, thank you.
Thank you.